Hey everyone, welcome back. My name's Levi. It is April 29th. Today is Tuesday. It's my favorite day of the week because I get to spend some time with you guys. We're going to talk about some options. We're going to talk about some long-term stocks, anything you want. I've got Seeking Alpha loaded up. Before I forget, Seeking Alpha does have a promo running for the next couple of days. It just started 2 days ago, and there is a link down in the description for my Seeking Alpha referral link. It's one of the services that I use all the time. There's a discount code there. They give me a little kickback when you use it. It's all part of like the cycle of are we building wealth together? If you guys are looking for tools, I use tools that work for me, and I don't promote things that don't work for me. So that's kind of how I function in general. And so if I'm using it, it's for a good reason. Because I think that it adds to my basis. Kevin, I've been thinking about you a lot lately. Thanks for joining me every Tuesday. I can't believe you're here just like clockwork every single week. It's fantastic to have you guys here. Easy Money, hey, good to see you. Thanks for the likes, everybody. It's fantastic to have you all here. We're gonna look at my screen, which, come on, are you really gonna do that to me today? That is fantastic. Just give me one quick second to see if I can get that rectified, and I'll be right back. All right, let's take a look and see if that's working, and it is not. I have a new splitter on order, and it's pained. I tried to buy something locally. You can't. This products available for this kind of high-end setup are just not very good. So, okay, let's look at GEV. I'm gonna have to go blind again. It worked great the other day on Thursday. It worked fantastic. GEV, which is GE Vernova, trading right now at 371. The quant rating as a whole, the valuation is an F. We've got, it's heavy electrical equipment. It's ranked in industry 3 out of 10 by Seeking Alpha. Its 1 year return is 133. The dividend it pays right now is negligible at 0.27%. That rating hold, where the growth is great, profitability is great, momentum is good. The question is it going to continue to go? I think with those types of plays, you have to be big enough accounts to play large stocks. Otherwise, we play with options. I'm not familiar with this stock enough to know whether or not the option is viable or not. Hey, Mike, good to see you. Dennis, hi, good to see you guys as well. I'm unfortunately having this continued problem with my splitter. I have ordered another one, but it's going to be a couple more days, I guess. So hopefully by next Tuesday, I am up and going, but I'm just getting black screen when I switch over to my screen, unfortunately. So I don't know what's going on with that. It's terrible. Let's clear that off. UNH, we'll take a look at that. So I'm just looking quickly at the options chain for GEV. We're talking about GE Vernova, and I am going to look out at the June 20th strikes, and we're just going to see if there's any volume. It's kind of a low volume. I think for those types of things, you're just going to be like bullish or bearish. Valuations an F, hold rating on Seeking Alpha. If I was to look at investing.com, let me pull it up here on investing.com, and then we'll see what it says about that. And my apologies again for not having my setup working fully. Worked fine on Thursday, so it's frustrating. Fair value is 314 according to investing.com. Downside of 15%. Current price is 371. So don't love that play for a long position. Maybe if you're interested in shorting it. Taking a look at what the market is doing today. Let's Let's take a look at SPX is up 0.76%, having kind of a midday rally right now. NQ up 0.78%, Russell 0.88%, VIX is down to 23.98, still relatively high. US oil hitting $60.46 today, down 2.4%, and gold coming down 33.17. So everything kind of slightly compressing as the market's moving up. There's people that are calling for a bullish run, so there's definitely potential. I think we're in one of those crux positions where we look at where we are sitting in the market. If I was able to show you a chart, where we're going to break one way or the other. I think one of the strategies that I might be considered deploying right now are really short duration, not super short duration, but like 7-day long straddles, and then using some sort of profit taker and then stop loss on them. So for example, if we looked at the Qs right now, if you on QQQ, if you were to buy like a 475 or a 476 long straddle, cost you about $1,400 to buy that. If we were to set a stop loss at around 25% loss, you know, you've got $1,400, 25%. So you're looking at a risk of around $350. And then setting a profit taker at, you could set it up to as high as 75%, but you could be somewhere in that 50 to 75% range, which means that on a $1,400 capital outlay with a $350 risk, we could return, you know, somewhere between that $700 and $1,000 in the next 7 days. And that doesn't matter which way it breaks. That we're kind of at a sweet spot right now where the VIX is still relatively high, indicating that we could get some movement, and then it's not so high that those straddles are just absolutely out of reach. So that's one thing to consider if you think the market's going to move. And the market has been moving, you know, relatively. You know, if you look at SPX today, you know, moving 40 points. So the NQ moving 144 points. I mean, NQ is 2000 strike right now. So pretty big, relatively speaking. What other questions do we have? We've got the UNH has given back quite a bit. Do you like it? I don't like UNH in general, but the, sorry, I'm not typing. United Health Group. Sorry, UNH. Yeah, boy, has it pulled back. No kidding. I'm just pulling it up here on Investing Pro. Fair value is marking at 548. Current price is 410. Current range between 409 and 630. So we're absolutely bottom of the barrel for the last year. And what is going on? You know, they've got, there's that 33% potential upside. RSI suggests the stock is in oversold territory. It's raised its dividend for 15 years, and the management has been aggressively buying back shares. Those are all pros. I mean, those things could be that the market could, or the stock could recover. 20 analysts have revised their earnings downgrade for the upcoming period. Let's look at the earnings and just see what happened here. So the announcement date was April 17th, and so the actual was 720. Their revenue was 109 billion, which was a surprise of minus 0.8%. And these last couple of quarters, we saw like this was a 22% decline. We saw a decline in January and we saw one in October. Are we seasonal in this? I'm just looking at the last January. So in the January reports from 2023, 2024, and 2025, we saw a decrease on all three of those January earnings reports. And then for the March report for 2023 was a decrease, for 2024 was an increase, and for 2025 was a decrease, 22% down. And that seems bonkers. Let me pull up. Let me just pull up a chart here. I'm going to look at, did you guys see the video I released this morning about that bullish position that, you know, using 3 long calls and then having 2 short calls that are in the money paying for them? This might be one of those situations with the stock so beaten up that it might be it might be a good time to get in on something like that. So let me just see how expensive it is. UNH. So the idea would be that you go out quite a bit of time. So you've got like a long leap position, basically. I like to go out, you know, almost a year at least, and then buy a position and buy those in the money. And the problem is you would ideally, with like a poor man's covered call, you would want to buy like the 280 strike. Well, it's expensive to buy 3 of those. It's $14,000 just to buy one. And so this might be one of those situations where it's smarter to just do a poor man's covered call at this particular time if you wanted to get some long deltas. So buying the January 16th, 2026 280 call and then selling the 440 June 20th, which is 52 days to expiration, 440 call, that gives a profit profile that is pretty decent. You have a total capital outlay of around just under $14,000. So that's the max risk. And that would be if the stock was trading under 280 in January, you would lose everything. The theta decay is positive $11 and has a max profit of 3,300. So if we wanted a bullish strategy on that, the other thing we might be able to do is buy like a little protection if there was, I'm just gonna look at doing like a put calendar spread to kind of try to protect that. So looking at the 370, which is 20 delta. So looking at June 20th, 25, selling the 370 put, and then going out to January of next year and then buying the 370 put for 2,800. That would give a very nice profit profile. It's having a hard time even loading this, but on the short duration, selling on the short duration, June 20th, sell the 370 put and sell the 440 call. And then on the January 16th, 2026 expiration, we're buying a put and a call, and the put strike is 370 and the call strike is 280. And that should give a very nice profit profile. It's taking a moment to load here, but what that would effectively do is give yourself some potential upside. The only problem is if the stock goes rocketing back up, then we'll end up with a loss, but it's a pretty neutral strategy. And there's about $20 a day in theta decay. It's a $15,000 position. And if we had peak, obviously would be about 440. Yeah, there's no upside risk on that. And as long as the stock stays above 400, which is not that low, that would be a potential play if you wanted some long deltas, because that gives you a 48 long delta, nice little bullish play, and relative for big accounts. Obviously, that's something to consider. I hate doing this blind. I'm so sorry that I have to do this. Hey Jackson, have you been eating lots of Burger King lately? Good to see you always. I just watched your round of video games. It seems too good to be true. 40% dividend yield, even if the ETF trails S&P 500 by 20%. Aren't you still way ahead? What am I missing here? There's decay in those. So the problem is with those yields is that the payout is so great that there's a cost incurred inside of the holdings. And so they typically are slightly underperforming, but it's a matter of what it is that you want to do. Now for people that are in a stage of their life where they're long stock and they're selling covered calls, there's a little bit of an underperformance of the S&P 500 in that strategy anyways, because what it does is it creates a cash flow. Selling a covered call in general creates a cash flow into our account, but it caps profits. So if you look historically at a long period of time, and let's just say that a trader held S&P 500 for 30 years, if you were to eliminate the handful of large market move days where the market moved up significantly, the amount of effect it has on your long-term portfolio is actually quite significant. So if you were to take like the top 10 days out of a 30-year period, it actually reduces the overall return. When we play covered calls, that unfortunately that muted effect happens. We cap our profits and we cannot achieve those maximum returns when the market goes screaming upwards. So any ETF that is doing that kind of thing has that built in. Now, the flip side of it is that a covered call strategy can actually create income for people when a market is flat. Now, so if we're in a very bullish time period, which we have been for a long time, those covered call strategies underperform, and we just know this statistically. If we get into a flat market, the covered calls will actually help with some income. So they create a more stable curve, so to speak. We get less highs, but we also get smaller lows. And it creates cash flow without having to sell off our equity. Now, one of the things that's happened is that there's companies out here like Roundhill that have said, hey, why don't we automate those? Why don't we look at something that would really benefit somebody and say, can we do these 0 DTE trades? Something that a normal trader wouldn't want to do, because you don't want to set up the automation, you don't want to pay for the automation, you may not want to have the time to do it. So they're taking all three of those things away from the individual retail trader. They're offering it, but they're offering it at a premium. They collect a fairly hefty chunk of that return at 1%. So we know that there's a 1% fee, and we know that kind of drags down on the overall portfolio. We also know that if there's strong bull market or strong bull moves, we're missing out on those. The nice thing about the Roundhill products is those ones in particular, their covered call strategies are 0 DTE, and they're not held overnight. So statistically, they actually give us a chance to make on the overnight moves. They're only capping our profits for about, well, the market hours are only 6.5 hours a day. So we're capped at like 32 hours a week, or 32.5 hours a week. The rest of the week, we have exposure to the upside, which is fantastic. So are they too good to be true? They could and have in the past couple of months underperformed the S&P 500 QQQ IWM, and I am tracking that closely. One of the ways that we can offset this is to not take our money out. We can buy when they're underperforming, and this gives us a better dollar cost averaging. So definitely to offset the decay, using those dividends and putting them back in will help. But they are designed for somebody that is looking for cash income, and they are pretty good products. Like, I am not, I've looked at lots of products. They're not leveraged in any way, which is good, and they're taking advantage of things that we wouldn't normally be able to take advantage of. So I have been buying some. I am reinvesting the dividends at this point, and we'll see what happens with their long-term performance. They are a fairly new fund. So wish me luck. That's I'm trying to do this research, and I'm trying to look at where we can make some money. Now the XDTE is definitely on the weaker side of those. Like the YBTC is a fantastic return because the dividends are just so massive. XDTE, I definitely am not going to add a very large position. I'm just kind of tracking at this point. The RDTE is probably my favorite one because I trade all of these products individually. Like, I trade QQQ, IWM all the time. I know where the premium is. There's not a lot of premium in trading S&P 500 products. So thoughts on Asana, Dennis? Well, I have had a long-standing position in Asana, and Dustin, what's his last name, Markovitz or something, is the CEO of Asana, and he has recently stepped back. I mean, they've been running that company since 2008. Dustin was one of the Facebook founders, so he's got more money than he'll ever need. And I, for a very long time, have been leery to sell covered calls against my position. I bought looking for upside potential. It hasn't come. I've been holding it for years. It is definitely not something that I am considering buying at this point. Dustin has recently stepped back. Just that happened in the last quarterly report, and we're moving forward. I can't see the stock appreciation. I think They're a product that is not profitable at this point. They have clients and they have a hard time with client retention. So if you read their reports and you look at their metrics and what's happening with their company to get people to sign up, and they have a hard time retaining customers. So that tells me that their product is probably not as good as it could be. Because I own shares, and because the premium's pretty good, I kind of feel like I want to exit this position. And so when I get to that position where I'm thinking about exiting, I immediately start selling covered calls, because what that does is it allows me to make some cash flow off those positions that I have already. That reduces my any further exposure that I might have. Then I also, if it does go up, then I get them called away, and that's okay. I'm okay losing those shares, and I'm currently not reinvesting at this level, so I'm just taking the cash out, and we'll see what happens. But there's lots of potential for that company to turn around. Maybe Dustin stepping down is exactly what we need. Maybe they need a little bit of a redesign. They need some guidance. He claims that he wasn't feeling it anymore. He was just needed to focus on something else. And again, he's, how old is he? He's similar to my age. He's like in his mid 40s and maybe a little bit younger. And he's been wealthy for his whole adult life. So I don't know what happens with people like that. Like, do you just kind of burn out and you're like, I've been doing this for 20 years, this software development, and maybe it's best for him to step away. I'm not sure, but I'm definitely not adding to those positions at this point in time. It was definitely something that I would be reducing my exposure to. Jackson, hi John, good to see you. Glad you're here. Jackson says, I've been playing Roundhill for a couple of months myself, reinvest in the dividends when there's a decent down day. I like the fact that we get to snowball the reinvestment every week. I know, like, that's the crazy thing, right? Is that reinvestment is big. So that's good to know you're waiting. I think that's the right play, like wait for a down day and dump money in, because you do have to fight that decay for sure. And we know that it exists in products like that. How is everybody's portfolio today? Are you guys up, down, sideways? Tell me in the comments. Let me know what you're doing. I've got some calendar trades that are doing very, very well. I've been playing these kind of little short duration calendars, and they've been killing it. Like more than 100% returns on some calendars already that are expiring later this week, and that has been fantastic. And those could just push even higher because they're so cheap to get into, and the returns are so outsized. So you can take like a calendar, buy it for $100 and then sell it for 400 later in the week. It's pretty great little trades. Also, we're looking at a little bit of upward pressure in the Bitcoin space, which is good. So in cryptocurrencies in general. So looking at Mara's trading at 1431. Still bullish on that. Looking at the ARKG products, ARKK products, I still like those. I'm playing those fairly neutral right now. They've kind of settled into a range that they were prior to the crazy COVID run up. And I think Kathy Wood is such an interesting investor because she's so transparent with what is going on. And I think that actually makes her funds valuations stay in a range more often than not. We see them kind of like do this little up and down, but they're quite range bound products, and there's lots of potential for them, especially from 2020. So even though it was already 5 years ago, it's like we're looking at that, and that investors continue to think, oh well, these products could go like ARKK, which is currently trading right now at 51.57. There's people that are like, oh, it could go to $100, and it could, but it's pretty unlikely that it's going to. So trading those trades and using, strangles, straddles, iron condors, and trades like that are, because those have so much potential to the upside, there's lots of money to be made on those products. Another nice thing to trade with those are like jade lizards in this high IV environment. If you're to sell a put and then buy or sell a small call spread above it, give yourself unlimited All right, so give us a nice range where we have a nice profit tent and then no upside risk. If it does explode to 110 bucks, it doesn't matter because calls can be pretty dangerous, especially on fast moving things. Or doing a calendar above and then selling the short put below. But those are relatively small products. Like for a ARC-K or ARC-G, I mean, ARC-G is trading at $2,200. So for a $100,000 portfolio, very simple to get in multiple contracts of something like ARC-G. If you want that exposure to something that's paying on a weekly basis with short duration calls, puts, things like that, the premium weekly is very, very high. So I like to trade double diagonals on those in high IV, iron condors, straddles, things like that. And Brian Quinn, what deltas do you do on the calendars? So usually what I'm doing is I'm looking at the chart. So when we're trading, say we're trading something like IWM and we're slightly below the moving average, which we have been now for a while, what I will do is I will just look at any calendar that is like in that 9 to 10 days out for the short, and then I add anywhere between 10 and 14 days on the top side. So I'm looking at like roughly a 10 day to 20 day, so about double, short to long, and then obviously they're the same strike because they're calendars. And then I'm just looking to deploy like $100. That's kind of the sweet spot. So when we looked if we were to look right now, 196.61, I wouldn't even look at deltas. I would just go out to the end of next week, so May 9th, and I would be looking at around the 202 or 205 strike on IWM. And whichever one of those, it costs me about $100. And look at those profit charts on those. It's pretty wild. You have potential of making up to $400, and your total risk is like $100. And because there's dailies on some of those products, you can just get a really kind of great equity curve that's working quite well. So when the market is down, we might take an opportunity to say, okay, I think the market might rebound a little bit back up into that range. Might be a good time to put on those spreads. So I'm using all calls. They're typically right now, they have been above in that $5 to $6 above the current price, and looking to deploy $1 per calendar. And then when they're that cheap, you can kind of scale up quite easily. Say I want to have $1,000 exposure, I just put on 10 contracts. And so that's relatively easy to scale for a multitude of account sizes. And calendars, I think, are pretty good. The call calendars have been decent. Sometimes you just make nothing off them, or the loss is really small. So it depends on the move that you get. Puts right now are a little bit harder because the volatility index, the VIX right now, is in a compression mode. So if nothing changes, I see Jim just joined. We've got a position on where with IWM, with puts specifically, or any product that has puts, when the VIX is dropping, it's really compressing down on the long puts that we've paid for. So if we do a calendar and we know the short is going to drop in value, but the problem is those longs are also dropping in value. So unless there's another event that occurs, like another sell-off, which there may or may not be, this volatility isn't going to spike. The volatility is more likely to compress than not. Remember, the average VIX is like 18. And typically what we're doing here, for most of my streams for years and years, you come on and we're talking about like waiting for that volatility to expand. Well, it has expanded. We are in the expanded zone now. So now what we're looking for, the expectation is that it's going to contract slowly. So we have to be prepared for that. We also have to think about what it is relative. If the market drops down, that volatility goes up. So it's very important to keep that in mind. So you have to think about what the play is. If the market goes up, the volatility will for sure decline faster. So it's already declining, and it will likely decline faster if the market goes up. hard trades when you're in that position for like double diagonals. This is a time, generally speaking, to do limited loss trades. So we are in high volatility. We lean towards verticals. So we look at vertical trades and say these trades are both out of the money. Is my risk to reward worth it? Am I getting a 30% return on capital for this risk that I'm taking? And then also playing with stop losses. That's another way to take some of that volatility out. But that's how I'm kind of looking forward, saying, the momentum, the trend right now, we have definitely broken out of that channel to the downside. If you look at S&P 500 or the Qs, we've definitely broken out. So from a technical analysis standpoint, if things continue to go up, inflation continues to come down, even if slightly, if we have some good earnings come out, this could really push up, but it could also sell off really quickly. It's a tough time. You kind of have to jump on a bunch of different strategies and be prepared to play with anything. I have long deltas right now, but I don't have extremely long deltas. So if the market went up like 10%, let's just say the market went up 10%, I would not be making 10% on my whole portfolio. I don't have that much exposure. If the market goes up 10%, I'll probably make 5%. So I'm having muted returns relative to the market, but I also have quite a bit of downside protection in from a market standpoint, because I'm concerned that we could sell off, and I don't want to have further gains. I've already had a little bit of a loss. I want to have further gains. I don't want to have further losses. I've already had a bit of a loss this year. It's been not a fantastic year. And so looking at trades that are trading to make some money if we stay in the range that we're in, because I don't think we're going to move to an extreme level either way. I think whatever move we see is either going to be a down leg or an up, but it's not going to be crazy big in either way, shape, or form. If the IV stays elevated, this is going to be a great year. By the end of the year, it's going to be a very, very positive year if we can stay in this elevated height of IV or VIX level. Mike says, Kathy Ark, sorry, that made me nearly spit up my drink. I am so glad that I can add some humor to this stream inadvertently, because I am not I've been told I'm a very dry person, but I don't think that I am. I love laughing with people. I just am not the comedian of that some people are. Coach Z, hi Levi, I've been watching for a few months now and I really like the live chat. Keep up the good work. Thank you so much. I really appreciate that. Brendan Quid, I'm a 30-10 guy. Awesome. Yeah, so that's in talking about like those calendars. 30-10 is also a good level. You know what? There's calendars, diagonals, they're kind of the hardest trades to kind of map out, like how are they going to work really, really well. They're quite inconsistent because they're dynamic, everything's moving around all the time. We can see like a volatility spike. We've got theta decay working against us, for us, and away from us. So they're very, very, they can be very fast moving, especially on the shorter duration. I would be interested, Brendan, how long do you hold them? Like, are you holding your 30-10 calendars right to expiration, or are you just playing the curve? Are you putting them on at 30 and then like taking them off with 2 days before the short? How do you like to set it up? I'd be very interested to know. And Mike says, I'm nearly 100% zero DTE these days. My patience isn't built well for longer term trades. Mike, are you trading with automation? I've been, not sadly, I've been spending a ton of time looking at automation and really trying to do some research. I've never run automation in any of my accounts, and I think that there's a ton of great products out there. What I'm actually looking for is somebody to work with and say, hey, can I help promote your platform? Because I get approached by tons of people all the time, and I feel like even myself with my own spreadsheets, it's like I build some really cool products that are super helpful to people, and people are leery to get on board. They somehow think that when we build out a product, or we need to build out our products on our own, or we don't want to spend the money, or what is, I'm not really even sure. Like, how is that? What is it what are the hang-ups for people? I mean, I sell quite a few of my spreadsheet templates and I get questions about them, but I find everybody's trying to like reinvent the wheel all the time. You got all these competitors doing similar things, and there's pros and cons to that. And I've been working with a friend of mine, and we've talked about this before. We're working on some automation. It's an extremely difficult thing to do. To jump into it from a production standpoint and say, what are all the hurdles that we have to jump through to get to that point? And the reason that I've been going down that road is because I look at the products that are available and I'm like, well, these aren't quite suited for what I want to do. So I'm interested, if you guys are using automation at all, what platforms are you using? What do you like? What are the things that we need to change about those? Because I think that as a YouTuber, one of the things that's happened to me is that I've been able to develop really great products because when I do sell a product, I get feedback on those. So my products have gotten substantially better over the years. And now I think that with automation, I feel like I have something that I could maybe give to those companies and say, what if I use them but don't just use them as like a user, use them as as somebody that's A, promoting them, B, using them but trying to break them a little bit and saying, how can we make these better? And there's multiple people out there, but I don't exactly know which one I'm going to go with and what is also available. It sucks that I'm Canadian. I was saying to Korean yesterday, I'm like, if I was American, not that I know nothing against Americans, I'm not, would never want, where am I going with this conversation? It has never been in my scope to say I want to be an American taxpayer. I think that's the biggest issue I would have with being an American is if I was a taxpayer, I'm beholden to being a taxpayer forever. And right now, as a Canadian, I can technically leave Canada and I would only have to pay income tax for 3 years or something after, and then I could like relinquish my my financial ties to Canada as long as I don't hold real property here. And these are always things that are interesting to people, to like, how do we develop, where do we put our money? At what age do you do that? Do you do it too early, too late? There's lots of factors in those things. And right now there's tons of products available to Americans. You guys are very, very lucky in that you can go through and you have a lot of choice when it comes to brokerage. You have a lot of choice when it comes to automation. There's tons of products being developed for you. So be thankful that you have access to that, because as a Canadian, we're quite restricted, and we're restricted in how we trade, which brokerages, what automation is around. Mike says, and Jim, thank you so much for the donation. By the way, that I really appreciate it. Those are the small things that help a ton. So I appreciate you joining, becoming a member there of the live stream group. Mike Mueller says, I've noticed that when watching P&L curves of double diagonals calendars is difficult. They're all over the place. I think when we look at if I could give my 2 cents on that, they are all over the place, and the opening trade with double diagonals, I always try to avoid super deep saddles, so that when we look at the profit chart, it kind of peaks up. And then if it's really shallow at the top, those are much better trades than the ones that are quite deep, because if they're too deep, they just don't function. And right now with the volatility, the way that it is, just with what's going on politically, it could just move so quickly either way. So those curves are not nearly as static as I would like them to be. There's, on earnings especially, if you try to do earnings trades with diagonals, people get absolutely slaughtered by them. Like, they look at them and you're like, oh, this is a huge P&L curve. I can make tons of money. I'm going to risk $100. I'm going to make 1,000. It's going to be fantastic. And then it's like they risk 100 and they lose money, even when they're like mostly right. It's crazy how much those can hurt. So you have to look at that volatility compression when you're trading with calendars, and you have to understand volatility quite well in order for them to function. And then Mike Mueller says, I've started dipping my toe into automation. I've been mainly a manual trader. My trades go in at market open and I just let them fly. Do you just run do you run no stops, or you must run stops, I'm assuming? Dan, are you still doing that Green Giant SPX trade? Yes, but there's been very, very little entry on that. And thanks, Jim, for the thumbs up as well. Dan, in answer to your question, the Green Giant SPX trade, I've been trading Green Giant trades, which is in general my spreadsheet that just tracks any cash settled position. It's basically built for SPX. It allows us to chart a 0 DTE trade, which is fantastic. And it can do up to 168 legs, which seems ridiculous. But if you've ever traded 0 DTE, if you've got, like, once you get into it, you realize how easy it is to layer up. You can buy a butterfly over here and create a big profit tent. If it moves into the tent, then you can buy another one outside and build a tent somewhere else. And you can kind of like make this multi-structured item. And that's why I called it the Green Giant, because it just creates this big nebulous web across where we're trading. And I had no way of tracking it. My software at IBKR isn't sophisticated enough to give me a profit profile, and it couldn't see the varied nuances. And I wanted to see like if the puts were making money, the calls were making money. So that's what I built. I built a spreadsheet that does all that for me. It's specifically set up for cash settled options because at the end of the day, it's just they all settle out to cash. So who cares if you have 168 legs? It's fine. So if you're in that trading mode where you're like looking at 0 DTE trades and you're saying, how can I build something today? And what is my real risk versus my potential profit? And what does the adjustment do? Our brokerage platforms can't always do that. So I built a sheet that does it. Lately, I've been doing a trade that is very, very simplistic in nature, and it's just like buying a long butterfly, but I only do it on days where the VIX is down. Today, the VIX is just super expensive right now. So today the VIX is down, and was it down on market open? I actually wasn't at my computer this morning. I was busy doing some video editing, and at market open, we were, why is that not loading? I think the market was still up. Yeah, the VIX. What are you doing? That's not being bad. Okay, I can't get my chart to load. What is going on? There's the VIX here. Just gonna look on a different screen. I'm looking at trading view. Yes, today it was slightly down at open. But I'm having a hard time justifying the purchase of. I'm just gonna look at a 1 minute chart here and see. So at market open this morning, no, the VIX was up, so it wouldn't have triggered an entry this morning for the trade that I've been doing. Basically, the trade that I have been doing is, if the VIX opens lower than the close of the previous day, so if the VIX is down on the market open, which today it wasn't, then buy a butterfly 30 points wide and buy a long butterfly at the money. And then what we're doing is we're hoping for a 30-point move. So in today, if we look at the 1 minute chart again on, and I know you guys can't see this, my apologies, SPX opened at 55.05. And 2 minutes into the day, it was trading at 55.26. So I would have purchased, and it wouldn't have triggered. Just to be clear, today was not a day, and there's been very few days that it's triggered this month because the volatility has been so high. But if we were buying, I would have bought the 55.15, and I would have been looking for a 30-point move above that or below that. And obviously trading right now at 55.63, so it would be in the profitable zone because the break even would have been 55.45. Now, it doesn't mean that we're going to close there, but that's a trade that I've been putting on in the morning, just 2 minutes into the day, and then just letting it ride. And the worst case scenario, you can lose around $2,500. But the potential on it is pretty great. You can make somewhere between $500 and $1,000 per day on those winning trades. This is why I haven't been doing it. Most days it wouldn't have triggered it anyways, but also the volatility index has made those long butterflies expensive. I was buying those butterflies for a debit of $1,000 or a credit of $1,000 if I did a put butterfly. 2 months ago, and they were fantastic. And now, I'm lucky if I'm getting like $500 credit to open a put butterfly at the money. And so that means my risk is bigger. Before I was potentially making $1,000, I was risking 2,000. Now, you're potentially making 500, but you're risking 2,500. So the reward is less and the risk is greater. It's actually a better environment for short butterflies, but then the movement happens. So it's hard. This is where we need automation. So when we're talking about those kind of things, that's, I want to do some more automated trading. My audio is too low. Is anybody else having a hard time with my audio? I'm looking at my, let me know, but I'm right at, yeah, I don't know. Doesn't feel like it's too low to me, but please let me know. Let me listen to myself. Can I hear myself? Testing 1, 2, 3. No, my audio feels fine. Audio's fine. Thanks, Coach Z. Okay, yeah. Maybe just turn up your speaker there, James. I'm looking at my audio meter and I'm peaking out right at minus 10 decibels. So I feel like I'm at the appropriate level for you guys to hear me. What else do you guys want to talk about? We're getting down to the last couple of minutes. I'm sorry I don't have any screens to show you today, but I'm happy to look at some things. That's making me think, do I need to move my mic a little bit closer? I was looking at pop filters earlier today, all the stuff, because sometimes I have this like mouth. It's weird. You like look at yourself on camera for so many years. I do all my own editing, and there's like this like smacking that happens. It's like mouth noise. I hate it, and it's one of those things that some people, what they do is, if like before you do a stream like this, you like eat an apple or something that's kind of tart, like you say you eat like a Granny Smith apple, and that'll take some of the saliva out. All these things. It's like, who knew? I never knew growing up that I was ever going to be in this situation where I'd be like sitting in my office talking to you guys and thinking about how wet my mouth is for doing a stream. But that's what happens when we get to the level that this is what's going on. See my note above. Oh, no stops these days. I run defined risk trades. It keeps me from having to worry about volatility spikes and or slippage. Yeah, interesting, Mike. And yeah, I ran a ton of defined risk trades like that I feel like it was 2 years ago now. I was running so much zero DTE stuff, and it was when I built the Green Giant, just going like crazy. How much stuff can I do? And I was, trading pretty big, and there was a couple of days where, you've got on, like I say, a $25,000 max risk for the day, and you're thinking, oh, it's going to be fine. It's not going to go there. And when you start to build out those profit tents, you kind of have to get there once, you have to have enough money to play with. And then there was a couple of times where it was basically like pinned right at where my risk stopped, where my defined risk was. And I was like, this is so not the way. Like if I had been trading with a stop, I would have stopped out and had a way smaller loss, and then wouldn't have had to recoup from those days where it's just like it goes right to where the defined risk was. And then the risk, even though it's an appropriate size for what I was doing, it was so big that the recovery took too long. So you're like, well, now I have to trade 10 positive days to make up for that one day that was like just a little bit bigger than it should have been. And I don't think that's the right way. And it's kind of why I stepped away from doing manual zero DTE trading. So I'm curious if you ever want to share your thoughts on what you're doing and how you're doing it. I didn't like the stress of it. I much prefer doing what I'm doing now, which is like working on some videos, working on some research, talking to people, looking at strategies and moving forward. Yeah, so Okay, I'm feeling like we've got all that talk about mouthfeel, and now I think I'm ready for some lunch. So I'm going to let you guys go. You've been fantastic as usual, and thanks for all the questions. I'm pushing a button. Why is that not working? There we go. That's better. Thank you guys. Amazing. It's always good to have you here, and we'll see everybody next week. I'm going to have that new splitter later this week, so hopefully I will have it for the Tuesday stretch. And on the 12th, I'll probably be down on the coast in Vancouver. So for any of you guys watching, if you want to grab a beer, I will be down there for a seminar, and would be able to touch base with you. Yeah, everybody was wired differently. Got to trade what you're comfortable with. Absolutely, it's like that's the thing about it. You know, what do we like, what do we don't like? You know, you've got to kind of find your niche. I know that my trading style is not for everybody. I mean, I like these kind of like long, slow curves. It just kind of makes me feel better. So you guys are fantastic. Thank you so much. We'll see you very soon.